Right, welcome to Electron FX, your number one channel of Forex education. Right? Today we'll be going straight to the point. We're talking about market structure. I did a 6-video series on market structure, part 1 to 6. I thought it wise to go through those things over again and in a more simple way. Right? I will just be compressing those stuffs and then putting it in a simpler format than the previous one. Right? So I wouldn't really be going into details of all those things like I did last time. This video is just like a summary of what I did previously on market structure. Right? Before anything else, I would like you to subscribe to the channel and like this video to get more updates. So I'll just give you a moment to do that. Subscribe. So just subscribe to the channel so that you can get more videos. Right? Subscribe now. Just subscribe now. Right? Subscribe now. In the next 5 seconds. 5, 4, 3, 2, 1. Right. Thank you. Thank you. Thank you. Thank you. So let's go straight to the point, the reason for this video, which is market structure. Now, the first thing that you need to know about market structure is that market structure is the makeup of the market, right? When we're talking about the market, we're referring to the chart, as you can see. All these candles, you see red candles going up, all these stuff you see here. Why do the candle reject at certain levels? Why did they look this way? Why are they moving in this way? So everything you see on the charts is what makes up market structure, the makeup of the charts, right? The structure of the charts, right? Why are they having this a specific pattern? You see the markets come and make a low, goes up, all of that. So that is the concept of market structure, right? Now, the first thing you must know in market structure is that we have about 4 kinds of trends in the market structure, right? They have about 4 kinds of trend. And the first trend that we have, I'll be fast. I'm not really be typing all these things out like I did before. So the first trend we have is the uptrend. And the uptrend is characterized by higher highs and higher lows. So that's the first thing we have. We have an uptrend. This is what an uptrend look like. Or we call it a buyer's market, right? So this is it. This was it looks like this is an uptrend. Let's add that just to make it fast. It's called an uptrend. Right. So this is an uptrend, meaning it's a buyer's market. The market is going up. Sorry. So this is an uptrend. This is an uptrend. The uptrend looks like. I'll shift it to the extreme. You can have more space to do that stuff. So I'll shift it to the extreme. So this is what an uptrend looks like. And the more, and it makes what we call higher highs and higher lows. You know, those stuffs. Let me just delete that higher low. Okay. So this is a higher low. Let's clone this. So I have another higher low here. Let's clone that as well. And then we have another higher low here. Right. So this is what an uptrend looks like. All right. It makes a series of higher lows and higher highs. So let's just clone this and rename it. Right, you know the drill and all of that. Higher high. So this is what an uptrend looks like. We have another higher high here. And then we have another higher high here. So that's what it looks like. An uptrend, it makes a series of higher highs and higher lows. And now, one thing you should know about an uptrend is that the most important part of an uptrend is the recent higher low, right? So that's the most important part of an uptrend, the recent higher low. because that is where the break of structure happens. So this is a recent, that's the most important part of an uptrend. Recent higher low is the most important. Right? You should know that. So the recent higher low is the most important for an uptrend. The recent higher low, because that is where the break of structure happens. It happens at this point, right? So you can also something like a box here. This is the most important part of an uptrend. This point here, here. So that's the most important part of an uptrend, the recent higher low, because that's where a break of structure happens. All right. So that is the first kind of market that we have, the uptrending market, the buyer's market, right? So we'll be deleting all this. Let me just shift it a bit to see once I can have space to do other ones. Let me remove this one too. Right. Now let's go to the next one. We have now the what we call the downtrend, and the downtrend is just the opposite of uptrend. It makes a series of lower highs and lower lows. So you see this often in a downtrend that you should know how to label all this. Right? You should know how to label this. Let's do this. So this is a downtrend. So let's edit this and put on. It is a downtrend because the market is trending downwards, right? It's trending downwards, and for a downtrend to be, um, you know, for a downtrend to be valid, we must be seeing lower highs and lower lows. You know, that's what makes up a downtrend: lower highs and lower lows. A low that's lower than the previous high, and a high that's bigger than the previous high, and the low that's lower than the previous low. That's the characteristics of an uptrend, lower high. Sorry, I had to use small letters. Should be using capital letters. So this is what you should see in a downtrend, right? Lower high, lower high, lower high. So let's make this complete. Okay. So this is lower lows. Should know all this. Should know all this by now. Should know all this. So I know that you know the drill about this. So the recent lower high is the most important in an uptrend. You should know this, right? You should know this. The recent lower high is the most important because that is where the break of structure happens. So that is the most important, the recent lower high, right? So the recent lower high is the most important part of a downtrend because it is where we have our break of structure. And then let us just talk about the next one. We have the range, and the range is characterized by this. You usually find the support above, something like a support above, something like a resistance below is a range. We call this a consolidation, right? And then in a range, you always find the market. It's not making a series, it's just going in between the zone. You see the market doing something like this. It's not giving a clear uptrend or whatever. Just see the market doing this, just bouncing. Sometimes to deliberately do a false break, come back, do something like a retest, take out this upper side, come down, do something like a retest, all of that. That's how the range looks like. You just range in between its particular zone and a resistance and a support. I won't be talking about resistance and support now. You should already know that. If you don't know what a resistance support is, just go to Google and type that out, right? So you have your support, right? So this is support. We call this a lower range. Anyone you prefer? So support or a lower range. So this is the upper part, resistance. Should call as a resistance. Right, so that is it about a range. So let me just add something here. As a range market. So we come here, we add A, right? So that's a range. That's a range. What is a range? Once the market is ranging, we mean that market is doing this. That's the third kind of market that we have. Right, so call this a consolidation, right? It's still the same thing. You can call it a range or consolidation. Consolidation. You know? So call this a range and consolidation. So these are the three basic kind of market that we have. And then I think we have the next one, which is not, I don't advise anybody to trade it, right? So that's what it looks like. It's something like this. So the market do this, so the market go up again, so the market come down, so the market do this. There's no clear pattern, right? Just randomly moving anyhow to go up. Just doesn't have a particular direction. So this is what it just looks like. I'm just trying to illustrate it. I don't really advise anybody to trade this kind of market because there's no head, there's no tail, nothing to guide your trading. So we call this a choppy. We call it a choppy market. So when the market is doing this, the market is actually choppy. Right? This is a fourth and final type of market that we have in our trend that we have. Called is a choppy market. Does not really have a direction, just go up, go down, and all of that. So for this course, we don't trade this. Once you see the market doing that, you stay away from the market because there's no bias or there's no guideline to trade even those kind of markets, right? So these are the three basic kinds of market that we should be trading. These are the three. Should be trading the uptrend, the downtrend, and the range, right? Now, I want to say that in an uptrend, you're looking to buy the market, right? You're looking to take your buys here at the higher low, at the higher low, at the higher low, and then to form a new higher high. Why in a downtrend, you're looking to take a sell from here, down here, take a sell down from here, down here, a sell down here to here. So you're looking to take a sell. When the market is trending downwards, you're only looking for sales opportunities. You're not looking for buy because the major trend is bearish because the market is heading down. So you don't want to be buying when the market is heading down. But is it possible to trade this upwards? It's possible, but to be safe, trade with the trend. And that is you trade this down, trade this down. So that is basically what you have. And then in the range, you're looking to take the market at the upper range, which is the resistance, or the lower range, which is the support. So they're looking to buy here, and you're looking to sell here, looking to buy here, and you're looking to sell here. So that is how to trade the range. But one funny thing about range is that a lot of stop hunts happen. You see the market doing this, and then you see a candle wick that will take out buyers and then continue to the upper range, take out. So this range is actually one of one of the most tricky, one of the tricky setups to trade because there's a lot of, it comes with a lot of stop wants and all of that. So that is that about the three basic kinds of markets that we have. The third one being choppy markets, which I don't advise anyone to trade at all. So you're looking to trade this kind of market where you find them in your chart. So let us delete all this so we can go to breakout structure. So we can go to breakout structure. But before that, let us look at real chart to see if you can find this thing that just explained, right? So as you can see from year to year, because this market was actually bearish. See lower high, lower low, lower high, lower low. This was a downtrend, lower high, lower low, lower high, and lower low. And then we had a break of structure upward. So you can see that this market was actually downtrend, a downtrend right from here down to this point. So this market was a downtrend at this point. Let's look at what market is currently doing as we speak. Let's check the current charts. Right, still the same thing. Market is trending downwards, lower low, lower high, lower low, lower high. You know, that's what I just explained now. Can you see it? What I just explained. The market is making series of lower highs and lower lows. So that's is it. So now let's go to the next thing, which is the breakout structure. Right, the breakout structure. Right. You know, I say that when the market is bullish, it makes a series of higher highs and higher lows, which is the uptrending market. But we want to know if this market will continue being bullish or will it change to being bearish. Right? Break off structure. So that's the next thing we'll cover here, the breakout structure. Breakout structure. Now, I say that in the bullish market, we have what we call an uptrending market. We have a market doing this, doing this, doing this, doing this, doing this, and doing this. And I say that the most important part of an uptrend is the recent higher low. So this is the most important part of this market. The most important part is the recent higher low. And then for us to have a breakout structure, right, we have to see the markets, right? We have to see the market come and close below the recent higher low. So when the market does this, we have a breakout structure, right? It must close. I'm not talking about a week. Price has to close below the recent higher low in an uptrend for it to become for it to be called a breakout structure. The price has to close, not a week. It has to close. It has to close below on the 4 hour, or 1 hour. At least 1 hour. 4 hours sometimes can be, 1 hour can be tricky sometimes, but let's use it as a minimum. Let it be 1 hour. Price has to close there below. If you're using the 1 hour structure to check it, then you want to see price close below the recent higher low. Right, so that is it. This is the breakout structure. Market close below, and then you expect something like this. Market's coming to give you the new lower high, and then the market changes from being an uptrend to a downtrend. So now, have you seen how the market has changed? This is the breakout structure. Once the market breaks structure, from an uptrend, it becomes a downtrend. And if a downtrend breaks structure, it becomes an uptrend. Right, so this is what you're expecting to see. This is a breakout structure. I told you that this was the most important point of an uptrend, the recent higher low. And let us use that same scenario for a bearish market. Now, remember in a bearish market, like I said, the market makes what we call lower highs, lower lows, lower highs, lower lows, and all of that. So this is a lower high, this is a lower low, this is a lower high, all of that. And I said that the most important point in a downtrending market is the recent lower high. So this is the most important point of this market, because that's where the breakout structure happens. As long as the market has not closed above that point, then it has not broken structure. So we want to see the market come and close above, right? Markets can come and close above this point. Give us something like a retracement and then fire up, and the market does. Come on, does give us up and continue rallying all the way up, all the way up, and all the way up. So this is just what basically breakout structure is. Very simple. Just see, when we just see the market close above or below the recent structural point, which is a lower high or the higher low. So this is a breakout structure. This is a breakout structure. This is a break of structure. And then let us just use that same scenario for a ranging market. I said something about the ranging market. It has its upper boundary and the lower boundary. So if we range to breakout, we don't really call this a breakout structure. We just call it a breakout. Call it a breakout, which is still a breakout structure, right? Still the same thing, but I prefer you go with the term breakout. So remember how what our range looks like. It looks like this. Remember, don't forget what our range looks like, or consolidation. So you see the market is, you know, in between the range, doing this, doing this, doing this, doing this, doing this, that kind of stuff. All right. So now this is the range. For this market to break this range, you want to see a close above or below the range on a bigger time frame, not 1 hour or 30 minutes, because you can see have a close, it will still enter the range, but sometimes messages it just do something like this and then still come into the range again, right? So you want to see this close on a bigger time frame, such as the 4 hour, 8 hour, 12 hours, 6 hours, and all of that. So this is when the market can close clearly below this zone. You should see something like this and then continuously rallying down. So this is a break of a range. You want to see price close below this range on a bigger time frame, not 15 minutes, not 30 minutes, not even 1 hour. You should be looking for some 2 hour, 4 hour, 6 hours, and all of that to be very short as broken. Because for using smaller time frames, it may close and then you see a week on the bigger time frames, and that kind of stuff. It happens. It happens. It happens a lot. I want to see if I can see where there was some kind of false break on the range. Right, like now you can see there was some kind of range here. The market was kind of trying to break, and look at this false candle. This candle closed above this range. So let us just draw that. If you look at what happened there, there was some kind of range here. It was kind of ranging at this point. Look what happened. It gave some kind of close, but still rally all the way down. So that was some kind of false break to take our liquidity, right? So we're not going into details of that. We just want to identify these things, right? So when you see them on the chart, you can easily know them. So this is breakout structure, and this is how to identify a breakout structure. That is the most important thing. And whenever you want to analyze your chart, the first thing you do is go to the bigger time frame. Go to the weekly time frame. Try to see the structure on the weekly time frame, right? Then you come down to the daily. This is what we call top-down analysis, which I may be doing in the subsequent videos, right? So this is breakout. You go to the weekly time frame. Try to check the structure of the weekly time frame. You come down to the daily. Try to check the daily. To come down to the 4 hour, 6 hour, and try to check the alternating structures, and then you come to your maybe 15-30 minutes to make your entries. And remember that your entries should be in line with a bigger time frame. If your weekly and your daily or 4 hour are all bullish, you should be looking to enter the markets when it becomes bullish on the smaller time frame, such as 1 hour, 30 minutes, all of that. Anyway, use for your entries, right? You want to see the market break structure on the small time frame, because breakout structure occurs a lot on smaller time frames. On the 15 minutes, you would always see so many breakout structure, but it does not mean that markets will just turn around overnight. So the most important breakout structures are the ones that happen on the higher time frames, such as the 4 hour, the daily, and all of that. Right? So that is it about the breakout structure. Right? Before I continue, I would like you to join our Telegram group. Right? So let's join our Telegram group to get more information. Join our, sorry, not a group, it's a Telegram channel. It's a channel. So you can join our Telegram channel to get more videos, analysis, and all of them. You can join our free Telegram channel. It's free. There's no price attached to join it. Right? Let me add that free Telegram channel. So just join our free Telegram channel with the link below. right? You can join our free Telegram channel with the link below or the link in description. Let me just use that in description. So just join our Telegram channel with the link in the description, all right? So get more from us, right? So you can join our free Telegram channel with the link in the description, right? So in the next video, we'll be talking about how to make entries based on our understanding of market structures. That will be in our next video. And that will be the last part of market structure remastered. Just 2 videos to make some points, right? So in the next video, we'll be talking about how to make entries, right? So that's what we're talking about. Just making entries. That is all we'll be talking about in the next video. Just making entries, nothing else. Making entries, right? So that's what we're talking about now in this video. Okay. So we're talking about now in this video, making entries, just making entries. That be what we're talking about now in this video. So that is it for now. Our mentorship program is still ongoing and is going for just a token of $60, right? You also find us in our description channel, in our description parts, where we'll teach you how to trade from scratch and all of that, all of those things. So the next video will be coming up very soon, maybe in a few hours time. So don't forget to join our Telegram channel, and then if you are interested in our mentorship program, just click the link and register as soon as you can so that you can start learning. We have started going forward with our lectures and we are not going to slow down. So do well to hit me up, or if you have any question, just comment in the comment section. If you have any question, just ask your questions in the comment section, and that'll be all for now. So that'll be the end of this video. Cheers and have a wonderful day.